Did you know that the US is a colossal giant when it comes to the stock market? It makes up roughly 42% of the entire stock market. Think of it like a heavyweight world champion when it comes to the investment world. So if you're crafting a well-balanced portfolio, it's essential to have a slice of this sweet American pie. And when it comes to consistent performance, does this deliver time and time again? Over the past decade, the US stock market has been like that reliable old friend that will show up no matter what the situation is. They've been the most consistently rewarding region among the major markets. Plus, when you combine the US stock market with index funds, with the fees being so low, they're practically touching the floor. So how should you, the investor, customize your exposure to the US stock market? Now, this is where the personal and personal finance comes in. Think of it like, how do you want your US investments served? Kind of like this picture over here. What does this have to do with investing and specifically the US stock market? Well, let's talk about that. First, we have the full platter. This is for those who want it all. Everything from your large caps to your small caps and your micro caps. This is a full meal when you consider the US stock market. Next, we have the classic flavor, and this is for those who enjoy that timeless classic feel, like a vanilla ice cream. This is where an S&P 500, because there's nothing more classic and timeless when it comes to investing like the S&P 500. Last but not least, there's something for those tech savvy. It's for those who want a bit of extra tech exposure when it comes to the US stock market. It's like getting that extra espresso shot in your coffee for that extra kick. When it comes to choosing your flavor, it doesn't matter if you prefer that straightforward approach or you're someone who likes to mix things up a bit. There is a US equity fund that suits your taste. And in this video, we're going to talk about the top contenders and how you can access that sweet American dream right from home with your portfolio. First, we're going to talk about that full platter option, and this is for those who want it all. This is the Vanguard US Total Market Index ETF, VUN. It's been around since August of 2013. The MER ratio is as low can be, probably one of the lowest out there considering what you're getting. 17 basis points, which means it'll cost you about $1.70 for every $1,000 you invest in this fund. Assets under management are just around $9.6 billion. And you get a bit of a dividend yield to sweeten things up a bit at 1%. It's currently trading around $108 per share. And the average annual return since inception is just under 16%. And here's why I'm a big fan of VUN. It's like the ultimate buffet when it comes to US stocks. It gives you a taste of everything from your giant tech companies like Apple, Amazon, to smaller, lesser known players like Summit State Bank. With VUN, you get exposure to the entire US stock market in one neat package. That is a win-win. That's why, in a nutshell, I'm a big fan of this ETF. Now, let me tell you about the perks of investing in VUN. And boy, oh boy, the perks are amazing. First is diversification. With VUN, you're getting exposure spread across over 1,000 companies. And what that does for you is that it reduces your risk. And that's something you want. Increased diversification and a reduction of risk. That's the ultimate combo. And when I say over 1,000 companies, I'm not joking, guys. Like, this has well over 1,000 companies in this one package, 3,656 to be exact. Let that sink in for a bit. With one ETF, you're getting over 3,500 companies working hard for you to get you well along your financial journey, to get you to financial freedom. Over 3,500 companies in one package. And for all that, what do you have to pay? That's a perk in itself. Low fees, as I mentioned. This will only cost you an MER of 17 basis points. Not too shabby considering all the things you're getting access to over 3,500 US companies. And the third perk is growth potential. Just take a look at the stock price, what it was back in 2013, and look where it's at today. And my gut feel is that it doesn't stop here. I'm excited to see what the next 3 years, 5 years, 10 years look for this ETF down the road. But if you ignore even all that, think about it. The US is home to some of the most successful and innovative companies out there. Take a look at this list. Apple, Google, Amazon, Microsoft, Nvidia, and this list can go on. But I'm not going to list over 1,000 companies out there. I'm going to stop right here. But you get the idea. You get all these powerful companies working for you in one neat package. And if for whatever reason you're not into VUN, well, let me give you some alternatives just to show you that it doesn't have to be VUN if you want that US equity exposure. If you want that, that full platter, there's other full platters out there that still gives you the same taste to the US stock market. The first alternative is XUU, which is the iShares Core S&P US Total Market Index ETF. Very similar to VUN, except XUU just tracks the performance of a different index, but you still get exposure to the entire US stock market. But one of the biggest differences of XUU is that the MER is even lower at 7 basis points. Yes, 17 basis points is much higher than 7 basis points, but in reality, all that means is you're going to save about $1 for every $1,000 you have invested between the two ETFs. The next alternative is VTI, which is the Vanguard Total Stock Market ETF. This ETF, just like XUU, just like VUN, gives you exposure to the entire US market. The only major difference is that this particular ETF trades in US dollars. Moving right along, let's talk about that vanilla ice cream. We're talking about the BMO S&P 500 Index ETF, known as ZSP. And it's been around since November of 2012. The MER ratio is only 9 basis points. That means it'll only cost you about 90 cents for every $1,000 you have invested into this ETF. Assets under management just shy of $17 billion. So it's a super popular ETF for investors out there. Dividend yield just under 1%. And it's currently trading at $88 a share. And the average annual return for this particular ETF since it's been around since 2012 is 17.5%. And that's what I meant with some of these ETFs, consistent performance from the last decade. And why do I like ZSP so much? Because it's your golden ticket to the 500 biggest companies in the US. Think of it this way. This ETF is like the creme de la creme of the American stock market. Think of it like an all-access pass, giving you exposure to the biggest and most successful companies the US has to offer, right in your pocket. And as the name suggests, it tracks the S&P 500 ETF, and your classic, timeless vanilla ice cream flavor. Now, let's talk about the perks of what you get with ZSP. I mean, the fact that you get the top tier 500 companies is a perk in and of itself. You're getting giants like Apple, Microsoft, Google, just like what you saw with VUN, but the focus is the S&P 500. So instead of getting the biggest names and the smallest names, it filters out the smallest names like your Summit State Bank, and it delivers the biggest 500 companies that are crushing it night in, night out. And the beauty about this ETF is another perk, that if a company drops out of that 500, another company will take its place. So it's sort of self-cleansing in that you will always have the 500 best companies that the US has to offer. The second perk is the low fees. For 9 basis points, which is 90 cents on every $1,000, you're getting access to 500 biggest companies in the US, night in, night out. And if one of those companies drops, you just get another company without lifting a finger. Self-cleansing, doing all the hard work for you. 90 cents, are you kidding me? Doesn't get any better than that. And one other big perk is diversification. You're getting exposure, you're getting actual balanced exposure to sectors from tech to healthcare, ensuring your portfolio is well-rounded. So if I've got your attention about the S&P 500, make sure you watch this video where I do a deep dive further into the S&P 500 and I talk about alternatives to ZSP. It's a great video if you're a beginner, if you're new to the world of investing and you want the S&P 500 working for you, because that could be your golden ticket to financial freedom. For coffee lovers out there, let's talk about the espresso shot. This is the BMO NASDAQ 100 Equity Index ETF, also known as ZNQ. This has not been around as long as the VUN or the ZSP. It's fairly recent when it comes to the world of ETFs, being around since February of 2019. MER ratio is a little bit on the higher side, but I'll explain why that's the case at 39 basis points. Assets under management at $1 billion. and a dividend yield at 28 basis points, not that much. But what you're getting here is the growth because it's currently trading at 90 bucks a share. But look at that average annual return, close to 22% since inception. Do you see why I called it that kick at the very beginning? That's that kick of espresso shot. Over 20% return since inception. Like, this is amazing. So why should you, the Canadian investor watching this video, why should you even care about ZNQ? And there's more to just that 22%. So let's talk through that. ZNQ is your ticket to the NASDAQ 100 index, which includes 100 of the largest non-financial companies listed in the NASDAQ stock market. You may be familiar with the New York Stock Exchange, but the NASDAQ is another big stock market available in the US. And the best part is this particular stock market, this particular ETFs, gives you some of the biggest names in your portfolio from the world of tech and innovation. And who doesn't want to be at the forefront of tech and innovation these days? And what are the perks of investing in something like a ZNQ? Well, ZNQ's exclusive feature is that it focuses on the NASDAQ 100, which is a hub of technological, innovative companies. Unlike the broader market ETF, which I talked about, like even ZSP and VUN, ZNQ offers a concentrated exposure of cutting-edge sectors like technology, biotech, consumer services. This is where it's at. It's at the forefront of technological change. And the other perk of ZNQ, as you've likely guessed on by now, is just the sheer growth potential. In the last 5 years, it has delivered an average annual return of 22% because you are riding that forefront of tech and innovation wave. So if you want to be on the cutting edge of tech and innovation and you want an easy way to get that exposure built into your portfolio, because you're not going to get that from Canada. You're not going to get that probably from other developed or emerging markets. It's going to come from those US tech companies that have proven to be at the forefront of innovation. ZNQ has your back. Do you see why I called investing in a NASDAQ ETF like a concentrated shot of espresso? Because you're really getting that kick. Take a look at this chart right here. I've pretty much listed all the features of each ETF and what you get for your investment dollars. When it comes to something like market exposure, VU1 covers the entire US market, which gives you that broad diversification. ZNP sort of funnels in on that, where it focuses on the top 500 companies, giving you access to established giants. ZNQ zooms in even further on the top 100 NASDAQ non-financial companies specializing in tech innovation. Diversification. VUN offers the broadest diversification because it gives you the entire US stock market. It's your full platter. ZSP is going to give you more of that balanced feel with your large cap 500 stocks, and ZNQ is more focused on tech and innovation sectors, which is ideal for those looking to capitalize on future tech advancements. Growth potential, as you saw, you're getting broad exposure with VUN. ZSP delivers high growth from the top large companies, while ZNQ offers a very high growth potential driven by innovation, driven by high growth sectors. Expense ratios, which is the dollars you pretty much have to pay to invest. VUN's expense ratio is 17 basis points, which is very cost effective considering the broad exposure you're getting to over 3,500 companies. ZSP, only 9 basis points, maximizing your returns from the top 500 biggest names. And ZNQ does offer the highest MER at 39 basis points, but considering it focuses on high growth sectors, it really justifies that higher cost. Any less return since inception. VUN has a very solid 15.7. ZSP edges a little bit higher at 17.5%, and ZNQ is leading the pack at 21.7 because of its higher growth potential for tech-focused innovation. But think about it from this perspective. 16% is the lowest annualized return. That's not shabby considering the S&P TSX delivers between 7 to 9%. So even with the lowest of the low in this group, you're still getting 16%. That's why it's so important for the Canadian investors to go outside of that home country bias, go outside of Canada and pick up that growth that you're not going to get in the TSX. So who are these ETFs for? Well, VUN is perfect for those investors seeking the broad US Market exposure, again, this is your full platter for those who want it all. ZSP is suited for those investors who just want the creme de la creme, who like that vanilla ice cream, that timeless classic, the 500 biggest names. And ZNQ is ideal for those wanting to invest in the leading tech innovation companies. Thanks for sticking around so far. Hopefully you enjoyed my deep dive into these ETFs. And as you can see, adding a shot of the US stock market portfolio is only going to do wonders for you and for your journey to financial freedom. And if you enjoyed the content, please hit that like button so I know that you want to see more content just like this. And if you haven't already subscribed, please hit that subscribe button, hit the bell notification so you don't miss out on future content. Also, don't forget to visit my profile on askme.com. Get your burning questions answered directly from me within 24 hours. That's all for now. I'll talk to you in the comments section.